Now, as part of this momentum that was gained from the Bamford decision, the government was also alerted to the fact that there was a need for a review of the taxation of trusts, generally to modernise their treatment. As I said, trust structures have been around for a long time, and the provisions that relate to trusts in the 1936 Act have been around for a while as well. But the nature of how trusts are used by individuals now is very different to what it was when those rules were introduced. They're used a lot more by everyday mum and dads, as opposed to just for intergenerational transfer of wealth, as they were historically used for in days gone by. So the government identified this need, and as a result have embarked on a review. Treasury's embarked on a review of the taxation of trusts that's currently underway, and we'll look at where that's at. And in the meantime, the Tax Office has recently, I think it was the end of March, introduced a tax ruling, TR 2012 D1, that looks at the meaning of income of a trust estate. So it's essentially setting out the Tax Office view as to what income of a trust estate really is. It's, I guess, another step forward from what they initially discussed in the Bamford decision impact statement. There's also at the moment a particular focus on the timing of trust distribution resolutions and minutes, and how those get done, what information needs to be in them, when they need to be done by, etc. And we'll look at that, particularly with year-end planning in everybody's mind at the moment. It's an issue that requires some attention. And in the background of all of that, we've still got things like Division 7A and UPEs that we need to deal with, the Tfn and TB reporting requirements that were introduced a couple of years ago, and although I haven't mentioned it on the slide here, also trust loss rules are always sitting there in the background that we need to turn our minds to when we've got losses in trusts, and the tests that need to be applied in those circumstances. So we'll start by having a look at the streaming rules, and the purpose of today is really not to go through a lot of these things in great detail, but more just in some cases give people a reminder that they're there, and where to look if they've got particular questions and issues that they need to deal with when they're dealing with these areas. So as far as the streaming rules are concerned, they were introduced with effect from the 2010-11 year, so we've had 1 year of income that we've had to deal with in relation to these rules already, albeit the legislation was really only passed right at the end of June 2011, so we didn't get a lot of time to really deal with the how the mechanics of those rules worked prior to 30 June last year. And the effect of these rules is that a trustee can make a beneficiary specifically entitled to capital gains and franked dividends derived by the trust, provided that it's allowed by the deed. That was a very important comment that was made in the EM to the legislation, that these streaming rules are there to enable trustees to distribute particular amounts of capital gains and franked dividends to beneficiaries, but if the deed doesn't allow streaming of that type of income, then these rules will be somewhat irrelevant. Now, the amounts that a beneficiary will be specifically entitled to are going to be streamed under these rules on a quantum basis. We've all heard about the proportionate versus quantum methods of distribution. So for the purposes of the streaming rules, we use the quantum basis. This basically means that a particular beneficiary is going to be taxed on a specific amount to which they're entitled, as well as on the tax attributes of that specific entitlement. So for example, if a beneficiary is specifically entitled to a franked distribution and is then they'll also be taxed on the franking credits that are associated with that distribution. I've had a few calls from clients and also from VinLink members in the last 12 months or so about whether we can split off the cash amount of the franked dividend and to one person, but give the franking credit to somebody else. There was a case in the Queensland Supreme Court, I think a couple of years ago now, where that was suggested that it could happen, but the government's made it particularly clear in the EM that to this legislation that no, the tax attributes have to flow with the entitlement itself. Now, amounts that aren't streamed to particular beneficiaries under these rules, so if you decide not to stream capital gains and franked dividends to particular beneficiaries, then those amounts will flow proportionately to the beneficiaries based on what's referred to now as an adjusted Division 6 percentage, or it may well be assessed to the trustee. Another important thing for those of you that sometimes look at the technical side of how these rules work, the streaming of capital gains and franked dividends are now assessed to the specifically entitled beneficiaries under different divisions. Prior to these streaming rules, the assessment in relation to trust income was all done under Division 6. Now essentially capital gains and franked dividends have been carved out of Division 6. Capital gains been put into Subdivision 115C and franked dividends in Subdivision 207B. So there's been a carve out of those two types of income, and there's a sometimes quite complex calculation that needs to be done to work out what then goes back into Division 6 to work out what the rest of the proportionally distributed income will be. Now, the streaming rules refer to some important concepts, and as I said, a complex calculation that's required to be done if you are streaming. Sometimes you'll get the same result as what you would have expected anyway, prior to the rules being introduced. Other times it comes out a little bit differently, so it is important to go through those various steps that are set out in the legislation now to work out exactly what the streamed amount or result is going to be. So some of the important concepts to understand include what is Division 6E income, so your capital gains and your franked dividends, or franked distributions. In relation to those, particularly like in the case of franked distributions, there is a requirement to offset against those franked distributions directly attributable expenses that relate to those dividends. So if you've got margin loans, etc., in relation to those shares, then those expenses will need to be offset against that type of income. So you need to determine what that Division 6E income is. The question of what is net income generally. There's also a concept of what is a financial benefit or a net financial benefit that's going to result for the particular beneficiary that's been made specifically entitled. And in relation to capital gains, there's a term in the legislation that talks about whether a beneficiary can be reasonably be expected to receive an amount. So you need to have a think about whether the particular individual or beneficiary is going to be can reasonably be expected to receive the capital gain that's resulted. Now, for streaming of capital gains and franked dividends to be effective for tax purposes, there's a few things that need to be kept in mind. One of them is that the beneficiary has to be made specifically entitled to the amount, and that streaming has to be done in accordance with a power that's conferred upon by the terms of the trust. And obviously the terms of the trust have to be applicable because of the operation of the law, whether that be legislation or common law. The specific entitlement also has to be recorded in its character in the accounts or records of the trust. So it's important that if you are making a specific entitlement of capital gains or frank distributions to a beneficiary, that you do record that in that manner in your accounts. Where you've got a frank distribution and it's streamed, the beneficiary has to still be entitled to a share of the trust income. However, in relation to a net gain that's distributed to a beneficiary, the beneficiary has to be entitled to the financial benefit referable to the capital gain. So there was some talk in the past of, if you had a discounted capital gain, you give the taxable portion of the discounted gain to one beneficiary and the non-taxable portion to another beneficiary. Basically, these streaming rules require that 100% of that amount, they get, if they get 50% of the gain, then they get 50% of the taxable portion and 50% of the non-taxable portion. And sometimes that can be interesting when you're looking at a trust deed to see whether you can actually distribute the non-taxable portion to as in the capital portion, to a beneficiary, because your capital and income beneficiaries might be slightly different, or you may not be able to make somebody specifically entitled to the income, to capital until a certain point in time, for example, on vesting or termination of the trust. So there's a few things to keep an eye out for there, and the key to all of these things that we're going to be talking about today, I guess particularly in the context of this current slide, is to always read the deed and be aware of what's in there. Now, I mentioned before the comments that in the legislation about someone reasonably be expecting to receive an amount. There was a tax determination issued in February this year, which explained the circumstances in which a beneficiary of a trust can be specifically entitled to a capital gain in a year, even in situations where the contract date and settlement date might straddle year end. The draft TD explains that reasonable expectation requirement is really being directed at the future receipt of the amount that's referable to the gain, should it actually arise. It's not actually the likelihood of the gain itself occurring. So there was some concern as to, well, we've entered into a contract pre-30 June, it doesn't settle till after, there's still a risk that the contract might fall over. So how can we say that somebody's reasonably expected to receive an amount? So it's not in relation to the likelihood of the gain itself occurring, but it's once it has occurred that they are going to receive that amount down the track. Now, I mentioned at the outset about the government realising that we needed to have a review of how trusts were taxed and modernising their treatment for tax purposes as far as the tax rules are concerned. That consultation process started at the end of last year. There was a consultation document issued by Treasury. Since then, Treasury has held a number of public forums in various capital cities, and various bodies and firms have made submissions to put their voice forward as to how these rules should be amended. The Treasury consultation paper actually set out a number of different options. Submissions that have been provided to Treasury indicate that preferences to one of those options or over others, whereas other submissions have actually suggested completely different options. So it's a as the name suggests, a consultation process. So that process is still continuing. When the consultation paper was initially issued, there was a timetable set out in there, and it was intended that draft legislation would be released for comment in July of 2012. Now it's June on Friday, and I'm not sure that we're going to see any exposure draft in July. The intention also was to ensure that the legislation started on the 1st of July 2013. And my understanding from the public forums and the submissions is that it is a particularly tight time frame, given the number of issues that need to be dealt with as part of this process. So it's quite possible that this start date will be extended later than 1 July 2013, which will will be good, will give us an opportunity to, one, get our heads around what the new rules will be, and two, to educate our clients as to how those new rules will apply and may impact on them going forward before we actually get the hard start date. So it's a little bit of a watch this space, that particular one. Now, the Tax Office obviously still thinking about how we deal with trusts and how they need to, you know, I guess in their mind, protect the revenue and deal with the taxation of trusts and making sure that there's no leakage of revenue in while this uncertainty occurs. So they've introduced or released Taxation Ruling 2012 D1, which is a draft ruling. Now, the draft ruling sets out the Commissioner's preliminary view as to the meaning of income of a trust, and it was released, as I said, at the end of March. And the date of effect for this ruling, because it's the Commissioner's maintained that his views never really changed in relation to what the income of a trust estate is. The date of effect for this ruling will be both before and after the date of issue. However, for matters that relate to before 2010, the Commissioner has said that this ruling won't apply to taxpayers that relied on the practice statement 2009-7, which basically talked about how capital gains would be distributed or be treated from an ATO perspective, while this uncertainty was around Division 6 and income of a trust estate. So if you have relied on that in the past, you'll be able to continue to rely on it or continue to have some comfort that things won't change in respect of how you've treated it in the past. But from 2010 onwards, you will need to be aware of the Commissioner's views in this draft ruling. So the ruling basically sets out the Commissioner's views on how to measure trust income in distinct income years. Also looks at amounts that can form part of trust income and amounts that form part of the distributable income of a trust. And it looks at a number of steps for applying Division 6. So things like what's the income of the trust for the income year, what are the beneficiaries' present entitlements to trust income, what are their respective proportionate shares in the income, are there any capital gains or franked dividends, is a beneficiary specifically entitled to any of those capital gains or franked dividends, and how much of the taxable income is going to be included in the income of the assessable income of a particular beneficiary and or the trustee. So there's a number of steps that need to be gone through when applying Division 6, and the Commissioner, yes, in looking at this ruling, has a view on each of those steps as to how that should be dealt with. So essentially, case law over the years has supported the view that the trust income, for the purposes of Division 6, means income that's legally available for the distribution to beneficiaries, sometimes referred to as distributable income. The ATO view in the draft ruling is that distributable income must be an accretion to the trust estate, so it must increase the trust estate. So from that, it really follows that something that formed part of the trust estate at the start of the income year can't itself be distributable income for that year, because it's already formed part of the estate. It was distributable income maybe last year or the year before, so it can't be distributable income in 2 years. And the Commission has also said that the distributable income can't exceed a certain amount, and that looks at certain accretions to the trust estate, less amounts that haven't been allocated by the trust deed, and also depletions of the trust estate over the period. In many cases, the distributable income of the trust that's determined in accordance with the trust deed or a decision of the trustee acting in accordance with the trust deed can be equated to the trusting net income for tax purposes. So there'll be those clauses that you see in trust deeds that refer to that trust income is equal to or means the amount determined under Section 95 of the Income Tax Assessment Act 1936, etc., etc. The effect of those income equalisation type clauses is that amounts that are received that wouldn't normally be considered income but are assessable, for example net capital gains, can form part of the trust income. Also means that outgoings that may ordinarily be charged against capital can reduce the distributable income of the trust if those amounts are deductible. So you might have outgoings for capital acquisitions, etc. And amounts that might ordinarily be considered income but which aren't assessable. So ordinary income that's exempt will be, those things will be treated as accretions to the trust capital, but outgoings that aren't deductible, for example entertainment expenses, will be depletions of the trust capital. So you can see that there are a number of things that can give quite anomalous results when an income equalisation clause is included in a deed. It's important to note that in this draft ruling that the Commissioner has taken the view that where an income equalisation clause is used and an amount's included in the net income of the trust but it doesn't represent an accretion to the trust fund, then he won't regard that amount as forming part of the distributable income of the trust. So essentially your equalisation clause doesn't really mean a lot if you don't have real income in the trust. So there's some important definitions in the ruling that need to be aware of. Income of the trust estate, which, as we've said before, is based on what the deed says. The distributable income, which I've just spoken about, what the Commissioner's view as to what that is and how that's determined. There's net income, and net income is the amount that's calculated under Section 95. So total assessable income of the trust estate less their allowable deductions. There's also these concepts of notional income and notional expenses, and using notional income as an example, that's an amount of assessable income that's taken into account in calculating the net income of the trust estate that doesn't necessarily represent an accretion of either cash or value to the estate in that particular year. Or it might represent an accretion to the trust estate, but there's also a corresponding depletion. And a notional expense is really the flip side of that. So what does that mean when we're looking at notional amounts and these amounts that are viewed by the Commissioner not to increase the value of the trust estate or deplete the value of the trust estate? What are those, and what does it really mean? Some examples that have been given in the ruling about notional amounts, and the examples that have been given, and as I said before, these amounts can't be taken into account when determining the income of the trust estate, however defined. So the common types of notional income amounts include franking credits. The Commissioner in the ruling takes the view that franking credits don't represent an accretion to the trust estate, nor are they an accounting asset, so they don't provide any future economic benefit to the trust. And he states that a franking credit entitlement is a feature of the income tax law and the benefit is conferred at the time of assessment by the law. There's also a situation with distributions from other trusts. So if a trust was to distribute an amount to another trust and the net income of the distributing trust exceeded the actual distribution that was made to the beneficiary trust, then the difference between the two doesn't represent an accretion to the beneficiary trust. So again, can't be that amount can't be legally available to be distributed to the beneficiary, and therefore is another notional amount, another example of a notional amount. Capital gains in the market value substitution rule also come into play, where if the capital proceeds are modified under the market value substitution rules, or the cost base is modified, then the difference won't result in a matching accretion to the trust fund. So it's a tax fiction again. Division 7A, dividends. Loans that are deemed to be dividends are considered to be notional amounts. Attributable income, so where amounts have been attributed representing income or gains made by foreign entities, where they've not been distributed by that entity, then the attributable amount doesn't represent an accretion to the trust, because again it's a tax fiction. The income hasn't actually been distributed to the beneficiary. It's really just an operation of the tax law. And also Part 4A amounts. There are certain examples where Part 4A might be applied, that and a trustee might be assessed, or a trust might have income included in its return, which is not really income as such. There's no real cash or value that's transpired as a result that is also considered to be notional. So all of those things you need to be aware of when you're doing your resolutions and looking at what exactly is going to be distributed to a beneficiary this year. To work out your distributable income is not just a matter now of just looking at the definition of income in the trust deed and going with that number, because if your definition is Section 95 income, then that Section 95 income can include a number of notional amounts that you'll, using the Commissioner's interpretation, will need to be excluded out to see whether you still have any real income to distribute out. So as I said earlier, with 30 June fast approaching, the focus is on year-end planning issues, and in relation to trust distributions and resolutions, there's been a bit of a focus from the tax office and also various accounting bodies and tax bodies, making people aware that they need to get their distributions done as by 30 June. The reason for that increased focus this year is really, I guess, stemmed from the overall focus on trust now. But late last year, I think it was in about September, the Commissioner had a long-standing administrative practice of allowing until the 31st of August for trust distributions to be made. And those income tax rulings 328 and 329 were withdrawn, I think, like I said, I think in September last year. So those tax rulings were really only effective for those trusts that didn't require distributions to be made by 30 June, or that didn't have default beneficiaries referred to in their deed. So the withdrawal means that this 31 August extension no longer applies. Now, many deeds have default beneficiaries that are entitled to income if the income hasn't been effectively distributed by the trustee by year end. Certain other deeds are silent on the matter as to how income will be dealt with if there's no distribution at 30 June, or some have a completely different date in them. So there's a number of variations out there, so it's important to be aware, I guess, as to when, from a trust deed perspective, distributions need to be made, but also from a tax perspective you also need to be aware of when distributions need to be made as well. The reason for that is that the effect of the withdrawal of IT 328 and 329, which I understand had some part of the reason behind the withdrawal was some of the comments that were made in the colonial decision early last year, that in order for a beneficiary to be assessed on a share of the taxable income of a trust estate, they need to be made presently entitled to the trust income by 30 June. So for tax purposes, that's, I guess, the area that was provided the extension by these earlier rulings. because they're no longer, those rulings are no longer around, in order for the beneficiary to be taxed on their share of the income, then they have to be made presently entitled by 30 June. That's sort of regardless of what your deed says as to when the distributions need to be made. So unless you want the trustee to be assessed or the default beneficiary to be assessed, it's going to be important to really have a good look at these distribution resolutions by 30 June. Now, having said that, some of you will be aware that during when the streaming rules were introduced, that legislation has hard-coded some particular dates in there to allow beneficiaries to be specifically entitled under the streaming rules. So in relation to franked distributions, that date was 30 June. In relation to capital gains, that date was the 31st of August. Now, if your deed requires a distribution to be made by 30 June, then the additional time that's provided under these streaming rules, particularly in relation to capital gains, is somewhat irrelevant, because the trustee is required to make a decision as to how income will be applied to beneficiaries, distributed to beneficiaries each year by a particular date, say 30 June. So the fact that the tax law allows you till the 31st of August to make somebody specifically entitled to the capital gains doesn't really help you out much, because you've already should have made that decision by 30 June. I've had some questions recently too about whether the resolutions need to be written or oral. It's one of those questions that the answer is it depends, and it usually depends on what the deed says. So the deed will sometimes specify exactly how the decision needs to be reflected, whether it's documented in a minute or a resolution or it's oral. The requirement really is from a tax perspective that the relevant present entitlement is created by 30 June. That's the overriding thing that we need to be aware of. Having said that, although a written resolution may not be required by the trustee, or the trustee may be silent on how it's reflected, I always think that it's a good idea for a decision to be evidenced in some form, some documentary form, in the event particularly of an ATO review or a dispute by beneficiaries. That's not a lot of occasions where you'll be asked to present the minute, although I'll give you a couple of examples shortly. But there is it's always a good idea to make sure there is evidence of the decision and when it was made, in the event that either of those two scenarios might arise. Now, the process of making a resolution will also differ depending on the terms of the deed. So how you make that resolution will depend on what's in your deed, but the things to consider will be things like what your trustee actually says, the beneficiaries, who exactly are they, making sure that the beneficiaries, the entities or individuals that you're proposing to distribute income to are actually beneficiaries that have been appointed correctly, what the income of the trust is, how income is to be distributed to beneficiaries, and that's usually referred to in the deed, and the payment or otherwise of the distribution, so how those distributions are going to be dealt with, whether they're going to be unpaid entitlements or they have to be physically paid or set aside for the beneficiaries. Now, the information that needs to be included in a resolution or minute is going to vary depending on the requirements of the deed. There's no set formula as to what needs to be in there. There are some practitioners that suggest that a lot of detail should be put into resolutions and minutes, covering off every last detail. There are others that are a little more, I won't say relaxed about it, but are of the view that less detail may be more appropriate. But things to think about of putting into these resolutions include obviously the general details of the meeting or the decision, who was present, details that the deed was actually tabled or referred to by the trustee. An indication that the trustee has determined that particular individuals or entities that they want to distribute to are actually beneficiaries of the trust. How the trust defines income, and if you've got a choice, then how the trustee has decided income is to be defined, and the process by which the income is going to be distributed to the beneficiaries, and how it's to be paid, applied, or set aside is the normal wording to the beneficiary. So all of those things need to be thought about when preparing a resolution. Unfortunately, I haven't found a cookie cutter type approach that we can use. There's usually something in a particular client's circumstance that means that the minute needs to be tweaked or changed to satisfy their particular circumstances. So yeah, it's worth having a close look at how those are done. And like I said, 30 June's fast approaching. Another question that I've had a number of times is whether we need to use, or the trustee needs to use, specific dollar amounts or percentages in a resolution. Again, really the only requirement is that there's a clear methodology for calculating the entitlement to the trust income. So that can be by way of percentage or dollar amounts or a combination of the two. Usually dollar amounts are particularly difficult to include because you don't really know what they are until the accounts are drawn. So it's percentages are usually a better way to go. But if you know of a certain amount that a trustee wants to distribute to a person, then you can say that there's a specific dollar amount, and the rest of the beneficiaries can be reflected as a percentage. When it comes down to it, the dollar amounts will be a percentage of the total amount that's been distributed anyway, so the percentages are able to be determined if need be. So unfortunately, as I'm sure you're all aware, clients don't always understand the legal or accounting issues that are associated with structures that they operate from, and they rely sometimes quite heavily on the accountant to assist them with that understanding or just dealing with the issue. So the consequence of this recent focus on trusts means that we as advisors really need to ensure that clients are made aware of the action that needs to be taken by 30 June in relation to resolutions particularly, and manage the risk of this increased focus from the tax office, particularly for both the client and also for our individual practices. A few things to look at actioning before 30 June is making sure that the trustee does resolve how the income of the trust is going to be distributed. Look at what differences there might be between trust income and net income. So if your trust income if you don't have an income equalisation clause, for example, your trust income is quite likely to be different to your net income, which is the taxable amount. And if there are differences, then look at how that impacts on the particular beneficiaries. The proportionate method will be applied, and you want to make sure that it doesn't give rise to some unexpected results for the beneficiaries or the trustee. Importantly, you need to make sure that the beneficiaries are presently entitled to the trust income so that the trustee is not assessable on the net income of the trust. If you're making specific distributions to beneficiaries of capital gains or franked dividends using those streaming rules, then make sure that specific entitlement is properly recorded. And the last point there that I've said is, ensure that distributions are not made by book entry or journal entry when the deed requires the amount to be paid or applied. If the amount's paid or applied, then it doesn't get to sit on the books. It's actually has to go out to the beneficiary. And just to comment on that, somebody told me years ago about how a journal entry only reflects the transaction. The journal alone is not the transaction. So making sure that there is something standing behind that journal entry to support that it's why it's being made. I've had a couple of occasions in recent months dealing with the tax office where they've made a comment along those lines that the journal isn't the transaction. So provide me with a document that that supports why this journal has been made in the first place. That wasn't in the context of trust distributions, but they are thinking about and aware of how we work these things. Now, the last thing I want to say in relation to distribution resolutions was Ato Compliance Activity. Recent months we've seen an increase in Ato comments about trust income and resolutions, various articles and alert bulletins that have been released. The Ato has indicated at this stage that their focus is on education rather than enforcing compliance. Although I'll make a couple of comments about that very shortly. That recently the Tax Office have announced a program where they're going to be contacting up to 1,200 trustees, advising them of their need to make resolutions by 30 June, and some of those will be followed up after 30 June, I suspect early in July, asking for details of the resolutions, so that they're looking to see how that the resolutions were done by 30 June and what information is in those resolutions as to how effective that they are. So something to be aware of. I'm sure that some of those letters will start flowing through in the not too distant future. Now, for something completely different, Tfn Reporting Requirements. These were introduced on the 1st of July 2010. Now, the quoting a TFN by a beneficiary to a trustee isn't compulsory, but where these rules are triggered, then if the beneficiary hasn't quoted a tax file number, then they may be, the payer, that being the trustee, may have to withhold tax, and that's at the top marginal rate plus Medicare from the payment before it's made to the beneficiary. So it's probably worthwhile from the beneficiary's perspective to ensure that their TFN is quoted. The TFN withholding rules are going to apply to two types of payments, basically distributions that are made during the year, so interim distributions, and also where a beneficiary is presently entitled to a share of the income at the end of the year, so the share of the trust taxable income. So in both of those circumstances, you need to be aware of ensuring that the tax file number has been quoted, and if it hasn't, then making sure that it is provided to the trustee within a particular period of time and reported to the ATO as well. There's a label on the tax return, I think it's label S, that refers to distributions from ordinary or statutory income during the income year, and a fact sheet that sets out when that particular label needs to be completed, that it's worth having a look at. Now, these rules will only apply to closely held trusts, and essentially discretionary trusts that aren't excluded trusts will be caught. Excluded trusts will be different. There are a number of excluded trusts as well from those closely held trust rules, and those excluded trusts are defined differently for some reason for the trustee beneficiary rules and the TFN reporting rules. So, for example, a family trust or a trust that's made an interposed entity election is not excluded from these rules for the TFN reporting rules, but it is an excluded trust for the trustee beneficiary rules. So don't assume that all, if you see one list of excluded trusts, just make sure what rules it's applying to at the time. Now, I mentioned earlier about the other things that we need to think about, Division 7A and unpaid present entitlements. This is really just a reminder that there is a ruling out there on the ATO's view on how UPEs and Division 7A will interact, TR 2010/3, and there's also a practice statement 2010/4 that sets out obviously the Commissioner's administrative treatment of these. So you might be aware that in the practice statement the Commissioner did allow an ability for self-correcting action to be taken where there was a deemed dividend, but it was inadvertent, or certain other things had occurred, which meant that it was probably not equitable, that it should cause a problem for the tax cost for the organisation. That self-correcting action could only be taken up to the 31st of December 2011. So if that action wasn't taken, then consideration might be given to applying to the Commissioner requesting he exercise his discretion. There was a ruling in 2010, I think it was TR 2010/8, that talks about the exercise of that Commissioner's discretion, and refers to where honest mistakes and inadvertent omissions were made, that he may exercise his discretion. So it's worth having a look at if you weren't able to make that self-correcting action by the 31st of December last year. Now that ruling that practice statement also refers to a number of options and ways to deal with UPEs. So I think before looking at each of those options, you need to first check the trustee to see whether the UPEs are to be held on a separate subtrust. There are quite a number of trusts out there that do say that unpaid entitlements are treated on separate subtrusts. There are others that say that they're loans straight away as well. But if they are on a separate subtrust, then that's all fine. It's already on subtrust, and you don't need to worry about these options so much. But where you do, the practice statement sets out these three options. You can put on an interest-only 7-year loan or 10-year loan, or invest the funds in a specific income-producing asset or investment. So one thing that I've noticed in the last 12 months or so, though, is clients need to be made aware that they need to have a legally binding agreement documenting the terms of that chosen investment option. You can't just do it by book entry or verbal agreement. Now, I mentioned before about the tax office being in an education phase in relation to trust distributions and resolutions, etc. And because of the general uncertainty as to how trusts should be treated. That will no doubt change in the future. One indication that it will change is that I understand the 2012 trust tax return information is going to be, the information required is going to be slightly different this year. The new information includes a need to provide details of trust income to be reported, the details of the share of income of the trust estate to which each beneficiary is entitled, and also the details of the beneficiary's share of net frank distributions that they're receiving. Now, this information will obviously enable the tax office to collect a whole lot of data and better identify areas of risk and risk to the revenue, and also targets for review and audit activity in future years. So just be aware that information is going to be required. So a little bit more work to do in that regard. And I just wanted to finish off looking at, I guess, a quick year-end checklist of things that we need to be aware of with trusts, not just from a year-end perspective, but because we're fast approaching 30 June. There are things that we need to keep in our minds when we're dealing with trusts, given the increased focus on the areas that I've spoken about today. But given that increased focus, there'll be other areas that impact on trust that will also come into view in certain circumstances that we just need to be aware of. One I said earlier was trust resolutions. We've looked at that. Distributions to minor beneficiaries was always a bit of a favourite by trustees to distribute amounts to minor beneficiaries. From the 1st of July 2011, though, children under 18 are no longer able to access the low income tax offset. in relation to unearned income. So essentially, provided that the minor beneficiary doesn't have any other income, only $416 can be distributed to a minor beneficiary without having any tax payable. So that's something to, may not be such a shock to us so much because it was announced in last year's budget, but from a client's perspective, it will, some clients it will impact quite significantly. Division 7A and UPEs, I've mentioned that, and looking at making sure your pre-16 December 2009 UPEs are quarantined, and that you treat post 16 December 09 UPEs in accordance with the ruling or the practice statement. The CGT small business concessions, normally we only think about those small business concessions when the CGT event happens, so can we satisfy the basic conditions and what concessions are available. These concessions, particularly in relation to trusts, can be applicable year on year, and that's because the significant individual test, 20% test, and also the 90% test, the active asset test and the connected with test all look at in some shape or form distributions that have been made either in the current year or in the previous 4 years. So you need to be aware of what distributions you're making this year and how they might impact on CGT events that may happen next year, the year after that, for example, to ensure that you don't trip yourself up inadvertently in relation to achieving the concessions that you and the client both believe that are going to be available at the time. Also, the trust loss rules. The trust loss rules look at a pattern of distributions test and the income injection test. So they both look at distributions that have been made. You need to get again, be aware of what distributions are to work out whether those loss rules are going to apply and how they might be impacted in future years. The potential application of Section 100A, that refers to reimbursement agreements. And the triggering of that particular provision, although it's not used very often, can result in a beneficiary being taken as not being presently entitled to an amount and the trustee being assessed on the amount. So just be aware that that's there. CGT event E4, although it doesn't apply to discretionary trusts, unit trusts that distribute non-assessable amounts to beneficiaries in respect of their unit or interest in the trust, you need to think about CGT event E4 because it may have the effect of reducing the cost base of the units held, or where there's no cost base left, giving rise to a capital gain to the unit holders. Interest expenses, that's another one that we need to think about as to the interest incurred on loans that are used to fund payments of distributions, making sure that they're deductible. There's a ruling 2005-12, I think it was, that talked about returnable amounts and interest expenses, etc. And the last thing, just quickly, because I think I'm running out of time, is in the streaming rules last year there were some anti-avoidance integrity type measures that were introduced in relation to distributions that are made to charities. And essentially where a trust makes a distribution to a charity, if the payment is actually made to the charity, then that's fine, they've got the cash. But if the amounts haven't actually been paid and they're going to be paid to them, then the charity needs to be notified of that distribution by the end of August. So if you've got clients that normally intend to make a distribution to charity at this year, for example, if they haven't physically paid the cash across, then they do need to notify them, notify the charity by that particular date, so that they're aware that they're receiving that distribution. So. Okay, well, thank you very much to everybody for attending. I hope you found it useful. If you've got any questions about the things that I discussed today, then my email is kreynolds@vincents.com.au. feel free to shoot me an email if you've got any questions, or get in touch with Morgan. But like I said, I hope you found it interesting, and if you've got any ideas for future sessions, then please feel free to give us a call. Okay, thanks very much. Have a good afternoon. Bye-bye.